Hi everyone, welcome to another Learn, Grow, Invest meeting. I'm Jermaine, I'm the founder, one of the founders of Learn, Grow, Invest. We're an investment community founded on biblical principles, and we're all about learning, sharing our experience and expertise with others. So we host meetings like this one now every Thursday, and we cover every single investment topic that you can think of. If you're interested in a topic that we have not yet covered, just leave us a comment below and tell us what you'd like to learn, and we'll be sure to include it for an upcoming meeting. So tonight I'll be speaking with Nick Green about common sense investing. And this is because based on our own discussion, we believe smart investing is not that common, right? So think of this meeting as an investing simplified, where we're going to be, covering some simple and practical steps that you should bear in mind as an investor. So right before I start, I'm going to say a brief word of prayer. Lord, we thank you so much for this day and everything that it has brought. We pray that as we discuss as investors, we will just be able to display wisdom in everything that we do. We pray for a lively and healthy discussion. In your name we pray. Amen. All right. So I'm going to share this brief bio for my friend Nick. So he's a private investor and writer at Crosswind Capital. He's interested in psychology of decision making within the markets. He's focused on investing in disruptive companies with a 5 to 7 year time horizon. So use that as your frame of mind for everything that he says. And so let's welcome Nick.
Pleasure to be here.
All right. So Nick, so I'm just realizing that probably the best thing for us to do to start is, what do you consider to be common sense investing? Because I'm just realizing we never really defined that term. So what can persons expect for this discussion?
Yeah, so when I think of common sense investing, I think that we're in a stage, or just in general, Munger talks about it a lot. People try to make investing something that it isn't. They try to make investing like physics or like advanced mathematics. And that's not what it is. At the end of the day, we're investing in our ideas that are run by people. And the revenue that is generated through those ideas are also purchased by people. Or the products are purchased by people. So that's filter number one. Number two, we have to access these companies through the stock market. And that is where a lot of the psychology, herd mentality, and the decision-making aspects come into play. It's not very hard, I don't think, to verse yourself to the point where you can find good companies. I think most people know what the good companies are. The problem is getting in and out of them through the stock market, which is why dollar cost averaging or indexing and basically forgetting about things has an advantage. I mean, being extremely long-term in and of itself gives the investor an advantage in the sense that they're not in there making bad decisions because they're making no decisions. They are simply sitting on companies that they like. So common sense investing is thinking about businesses rationally and thinking about the market that they are sold on rationally. You don't need a complex system or algorithm to trade in and out of these things to do well. And I just think that it's something that, anybody spends some time doing can get good at.
Yeah, so I definitely agree with you there. One of the questions that we answer most often is, when do we buy, when do we sell, when do we hold? That I think if investors knew how to answer that question, would all be in a very different place. So where do you think we should start? What's the first thing that you would say we should do in this process?
Well, something that I was told when I first started investing that I think is really good advice, and I don't hear it too much. It's sort of, follow your passion, yada, 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 which is kind of a cliche, because if you're passionate about something, you're already doing it. You don't need somebody to tell you to follow it. So, but follow your natural curiosity. So when I first I first started out trading, and I was not successful at it, to put it politely. So I started investing with a longer term time horizon. And one of the things that I was told by a mentor of mine was, okay, what's a company you're interested in? And I just sat there and I thought, well, I've always sort of been interested in aviation and engineering, and I'm familiar with Boeing. He goes, okay, read Boeing's 10K. I said, it's like 300 pages. He goes, read Boeing's 10K. So that was my first introduction to understanding sort of the language of business, how they report what they're doing, what the risk factors are, what the equity and debt breakdown is, looking at the income statement, looking at the balance sheet and cash flows. And did I really understand any of it? Not really. But over time, as I started to read more and more of them, I became better and better versed in the subject. And the reason it's important to start with something you're familiar with is because you can understand it. When Boeing was talking about the projects that they were doing and talking about breakdowns of revenue and things like that, I could understand it because I understood the products that they were selling, and I had a somewhat of a grasp of the industry and how airlines leased these airplanes and things like that. So if you start off looking at companies that others are pushing on you because you think that they have high revenue growth or are in some, whatever it is, industry that you think is appealing, you're not going to learn. The hardest thing to do, which is the thing you have to do the first 2 or 3 years, is toss making money completely out the window and just realize you have to learn. That's it.
Yeah. So I just want to underscore that for those who are watching, because if you start by not worrying about how much money you can make, because the thing that attracts most people to the stock market is when they see those posts or those, stories on the news about a stock that went up, 100, 200, 1000%. And you just think, okay, let me take advantage of this before, the train goes. And they don't think about, okay, let me start with learning about the process by reading up on companies I understand. So if you are familiar with, if you're a doctor, start with pharmaceutical companies. If you work in retail, you can look at a company like Amazon, or locally maybe Fontana, so things like that you can use to make it easier to understand the business speak because you understand the industry speak. So yeah, I just wanted to highlight that one as well.
Yeah, no, totally right. And you'll actually, as you get better, you'll learn that those original companies that you understood are going to be the ones that you gravitate towards, even when you really know your stuff. Because in order to invest properly, not only do you have to have an understanding, a general understanding of a lot of big ideas, like that quote that I sent you, synthesizing a bunch of ideas to be able to spot something that's really an opportunity. But being well-versed in that specific industry is going to make you better than the guy who isn't, well-versed in that industry. And that will not only give you a better understanding, but it'll give you the confidence to hold when other people start to panic, because you'll have such familiarity with what's going on that you won't really budge.
Yeah, that's definitely true. So if it is that, and I found that with the companies that I hold, because I know the industries very well, even if the prices go down, I'm like, well, based on the cycle of this company, it may pick up 2 months from now, 3 months from now. I'm not worried if they have a bad month or even a bad news story, because I know the industry well enough. So the price doesn't affect the value of the company on that given day. So
that's correct. Yeah. You're doing a common sense thing, which is operating where you're supposed to operate. And people get in a lot of trouble when they have the hubris to run around. Being a specialist is something that is broadly accepted throughout all professions, except kind of investing. People think that they can show up and they can own genomic stocks, and they can own hydrogen energy stocks, and they can own industrial stocks, and they can own tech stocks. And that's fine if you're just kind of blending together some portfolio that, you think is going to diversify you, but it's not, you're not operating in an area that you understand and can really relate to. And this is why when people talk about having a concentrated portfolio, it's less so that they think that it's better to own a small number of stocks. It's the point I think that people really try to convey with a concentrated portfolio is that you only need a few good ideas that you know to do well. So if you can find 3 companies within a decade that you are just completely set on, you understand, you can value them, you know who they're selling to, you know the industry, and you have confidence, you will probably outperform the guy who's all over the place thinking he needs to balance out this portfolio and buying things that are totally outside of his realm. So that's really what the concentrated portfolio thing I think is trying to get at. And it is a sense of just having common sense. Understand what you own, understand what works, why it works, and buy it at a fair price. That's basically what investing is.
Yeah. So in terms of that information about the companies that you're interested in, where would you go for that information?
Well, so if you want to read the annual reports, for US-based companies, you go to sec.gov, and at the top right, you can enter the ticker. And you can read the 10K, which is the annual report, the 10Q, which is the quarterly report. Second to that would probably be on the company's website, investors relations tab. Yeah. They have a lot of good stuff on there, and they'll usually present things that are probably even more understandable than the 10K, especially if you're new. But the real original source is going to be on sec.gov. You want to get good at being able to dig through a 10K. And then lastly, I would cultivate a good following on Twitter of people that put out high quality equity analysis pieces and things of that nature. And besides that, it will just kind of come down to your own experience and being able to synthesize these ideas. But I would start there, investor relations, sec.gov, and look up the tickers on Twitter and see if you can find anything interesting through there. Because as cool as Twitter is, it's also sort of a good search engine.
Yeah. So what I would add to that, so what I do locally is that we have a website for the stock exchange, Jam StockX. So that's where I go. So I follow them on all social media. So they'll post news there. I'll follow the local newspapers, to see if there's anything that they'll post. With the newspapers, you'll get, general news, not so much of the company news that you're hoping for. But what I'll tend to do is just scroll past anything that I'm not interested in. Or maybe once per week, I'll just search for the company in Google and look up all the articles that are recent about that company. And then I'll try to learn, what's going on with them, just in case, maybe it's been a few months, I haven't looked into them and I want to understand what's current. So that's what I'd add to that.
No, it's true. The news thing can get a little bit, especially if you're new, you can talk yourself into selling or buying more based on the news topics that you see. So in the beginning, I would just avoid the chatter completely. I hardly pay attention to it. I mean, sometimes companies report quarterly earnings and like my friends will text me like, oh, it's up. I'm like, what's up? Like the stock you own. I'm like, oh, okay. So it's,
So wait, I mean, that's an important thing I don't want persons to miss, right? Because what I've noticed is that sometimes the news about a company is strategic. Like if it's close to the end of a quarter, they'll release the positive news. If maybe it's like a certain point of the month, or sometimes even for us, I see where they'll release news on a Friday evening, stock markets are closed, or on Saturday. So like I've noticed sometimes that the news, and when it comes out, it's definitely not coincidence, I think, because they have control over when that stuff is released.
Yeah, no, there's bad behavior both within the businesses and market participants for sure. Which is why I tend to ignore it. I just don't think that it adds a lot of value. And it's also one of the reasons, like I do look at price a lot and I do quite a bit of technical analysis. But I do it mostly on weekly candles. I try to really space it out. It puts days like today or yesterday or the last few weeks kind of into perspective. So that's another thing that I would do. Just slow yourself down in general, especially in the beginning. Start small, act very rarely. I mean, you were going to bring up like some of the biggest lessons that I learned in investing, and I was thinking about it. And if I could boil all of it down, it would just be to do less, because every time you make a decision, you increase your chances of screwing something up. And it just comes down to self-control. So, and that took me time to realize. I was like, oh, I haven't touched my portfolio in 8 months and it's doing really well. I wonder what the one factor is. And it was me.
Yeah.
So,
So, I mean, the more you learn, I think the less you do. So, I
Absolutely.
mean,
And the more
once
you
you
can ignore,
understand,
the more you can
yeah,
ignore. You
yeah,
gain filters and you have confidence in yourself and not what's going on outside of it.
yeah, agreed. So, in terms of the next step, so, we spoke about, following your natural curiosity as a person, not even an investor, but as a person, reading through the reports, reading the news, that kind of stuff, or filtering the news rather. What would be the next step, you'd say?
Well, the next step would be probably reading investing books and also just getting well versed in accounting. Um, a lot of people, I started off trading having read like a book or two. And I actually think that that was better because when I did start to dive into reading, I had a little bit of a baseline to work off of. There's a lot of people who read like 10 or 15 books on investing, and then they'll be like, okay, I'm ready to start. And it's like, you were not able to relate to anything you read. So I would recommend getting your hands dirty a little bit. And then kind of at the same time diving into the books. It will also motivate you when you start losing money to take notes, to annotate, to read.
Right.
If you're just reading about these topics and it's all fugazi in your head, it's not really going to do anything. So I would recommend getting there's a few books out there that just talk about broadly about accounting, how to read financial statements. And then if I could recommend some books, it would probably be The Most Important Thing by Howard Marks. It's a very good book. One of the best books on investing, period, especially with a emphasis on psychology and decision making. Trading in the Zone by Mark Douglas also is in that category. William O'Neill, How to Make Money in Stocks is a good one. That'll kind of get you into understanding a little bit of technical analysis as well as looking at earnings per share, fundamentals, things like that. And then probably the number one is going to be Reminiscences of a Stock Operator.
Okay. So
That
I,
one,
I hope I hope our mods got all of those books. If not, Nick, I'll just ask you to tweet it out after this so that
okay.
we can be sure to get all those 4 books.
Yeah, Reminiscences of a Stock Operator is the interesting thing about markets. People often say history rhymes, history repeats itself. And to a degree, that's true. There is no area where it is more true than in the markets because humans don't really change. We have the same folly in the sense that we want to participate, we want to make money, we get scared, then we get greedy. These things all occur over and over again. So the
Yeah.
businesses within the markets change, but the participants don't change. And if you can understand that, you're getting somewhere.
Yeah, it's actually quite amazing to me that you know about it. Like we're talking about it right now. And for each person I find it's different because there are companies that I don't have a problem with missing out on. But sometimes if I do an analysis, I say it's gonna go in this way, and then I see it, by reflex, I start to feel like I've missed out because I made a judgment and it happened to be right. Completely forgetting that, a week ago I was saying don't fall for it because it's gonna happen this way.
Yeah.
But it's amazing how much we think we're self-aware, but then we fall for the same traps that a person who is self-aware shouldn't fall for, kind of thing. So
Yeah, people underestimate how strong the strings are in the market at pulling you in a direction. They're very, very strong. And you'll see people have a hard time realizing what's right in front of their face because they either are rationalizing a stock going down, rationalizing a stock going up. Recently, we've seen a lot of people saying, oh, well, I've learned a lot. I should do this, that, and this. And part of that's true. But over time, you also start to realize that recency bias, both works when you're 6 months into a bull market and you think you're doing really well, and when you're a month or two into some chop or a bear market. There's nothing wrong with being down 10, 15%. Now, if your limited partners call you and say, why is the portfolio down 30%? And you say, we're long-term investors, they're going to pull their money out. But if you're a private investor and you can handle some volatility, it's totally fine. And you have to be cautious about thinking you're good in a bull market and thinking you're bad in a bear market. It's just part of the thing, it's part of the game.
Yeah. So what are some of, just assuming that they are completely brand new investors in the meeting here with us, what are some of the accounting terms that they should look out for, or the the different financial statements that they should get to know?
Right. Well, the terms change depending on the industry. So usually in the beginning of a 10K, they will say what's going on. Like in a lot of e-commerce or online platforms, there's MAUs, which is monthly active users, but those also don't exist in something like a Boeing. They don't have monthly active users. So read in the beginning, it'll state that, but that's less important than just being well versed in what an income statement is, what it reports, starting with revenues, working down to operating income, things like that, down into net income, looking at the balance sheet, current assets and current liabilities. And then really probably the most important would be cash flow. So, people talk about, the top line growth, the bottom line growth, and that's fine, but it all has to matriculate down through the cash flow statement. And that's something that people don't realize. And a lot of our modern companies, it's something that I've been reading about a lot and trying to understand better. They don't invest through the balance sheet like a lot of the older companies did. A lot of the investments that these companies making are in research and development, and they're actually going into general administrative and sales. Basically, they're helping build ecosystems, networks, flywheels, technology and R&D, things like that. So this is more advanced, but understanding that earnings, because you can have a company that has positive earnings and negative cash flow. It's better to have a company that has negative net earnings and positive cash flow because they are financially more healthy. So there's a difference between having a positive accounting metric and being cash flow positive. Cash flow positive is opening up your bank account and seeing money in it. Positive earnings is like having a check in your hand, but having it get blown away in the wind and fly into the gutter. So there's just things like that over time you'll learn. But this is more one of those things where you kind of have to just sit down and read a few boring books on accounting. And it's one of those things that just it's the language of investing.
But that's an important thing you're saying, because there are moments where persons can over highlight or emphasize certain ratios or certain things about a company, but you can just look at that company and say, well, that's not really attractive. Like there are lots of things that could be that the industry is very slow, or there's a great risk to that company. So it really does help to understand the company itself, because the ratios are based on historical information, because you can't do a ratio on future earnings because you don't know what the future earnings will be. You can project or forecast, but it's not reality until that future comes and you don't know, right?
Correct, yeah. And the market is very dynamic. PE ratios across the board can vary a lot and all be equally worthless. I'm not really a fan of ratios, to be honest. It's much better to get your hands dirty and think about a company in the future and what they're doing than it is to just sit around and compare a quick ratio. Everyone can do that. If somebody can do something easily, it's either arbitraged out of the market, or there's just no opportunity there. So that's also something to understand. If you're just spouting out figures that everybody else knows, or you're in a crowded trade, leave, because there's nothing left there.
Yeah, I know a lot of. I've seen this recently as well, where they'll say, a company's PE is under a certain amount, it's a must buy, or it's automatically, considered undervalued. And you'll see a buy recommendation based on just the PE, when it's really just one of so many things that you should be using to really assess the company. So yeah. I think I agree that person should just be mindful of those just numbers that don't really tell the whole picture of a company, right?
Yeah, just be mindful of shortcuts in general. That's what these ratios are. They're just shortcuts. They're just little financial snapshots, which is why, just going back, dig through the numbers, read the annual report, and not only will you get a clear mindset of what's going on, but you'll develop the skills to be able to really look at companies and get the truth of what's going on. So, you should know what a PE ratio is. You should know what enterprise value to revenues or sales is. These are all going back to like immersing yourself in accounting. These are things you should know if you want to be, an investor. But it doesn't really fit into my idea of common sense investing to trust a
Yeah.
PE ratio to buy a company.
Yeah, yeah. What are some of the terms that, someone who calls themselves an investor should know? I mean,
That's a good
just like,
question.
yeah, like sometimes you'll see a tweet about a company's earnings and you see some words,
Yeah,
what
a
are
lot of
some
times, I mean, I guess just off the top of my head, if you're going to be a long-term investor, you have to understand, like Y over Y is year over year, understanding that that's figures now compared to a year ago. And that way you can analyze how margins are improving or what direction growth is going, things like that. Current assets and current liabilities, seeing if they're, adding more to liabilities or if they're sitting on more cash, if they have more assets, or if that got deployed somewhere is an important term to know. Operating income, or NOPAT, net operating income after tax, is a good one. Again, getting a little bit more technical, but a good place to start would just be at the bottom of each financial statement.
Yeah. So what I like to do is I really try to, if I see persons are talking well about a company, I would go to look at the financial statements and try to understand it myself. Because if it doesn't look good to me or it doesn't make sense to me, then I'd be like, why is everybody so excited? Like, I'm not seeing it. If I can't see it, then I won't buy it.
Correct. Yeah.
I'd rather risk being wrong than to invest, because a lot of investors will buy, they're up and they don't know why.
Yeah, exactly.
So, I mean, that's a very dangerous game.
Yeah, I think really the biggest advantage, the greatest superpower that investors have, and this is why Buffett likes to talk about the baseball analogy of sitting there and waiting for a fat pitch. What that comes down to is having the discipline to just say no. You have to be okay with seeing other people make money when you either don't understand it or you just don't want to participate in it. Buffett sat through the entire tech bubble. If you think that was easy, you're wrong, especially him already being at the level that he was at
because he had the money to lose. He had the money to lose.
He had the money to lose, but he also had the money to gain. And when you have a bunch of 14-year-olds like we do now with Doge telling you that they know better and you're living in the past, I'm sure it wasn't easy for him. So it really is your greatest asset. You have to be able to sit down and go, do I understand this? You have to not be greedy. You have to invest prudently within your circle of competence. These are all lasting principles that have currently stood the test of time and will still be relevant, I think, in 10 or 20 years. And that's why I like to talk about intellectual honesty, because if you're not being honest with yourself, the market will eventually tell you.
Yeah, I agree. All right, so we're getting some questions in the comments. I'll get to those in a second. Talk to me, Nick, about this concept called getting skin in the game. What does that mean for you?
Yeah, so when I say skin in the game, you basically have to have something that if you fail will cause you pain. Because pain is the first step to being able to reconsider your actions, think deeply about something, and be open to new teachings. So when you're paper trading up and down all day long and it doesn't mean anything, or you're reading a lot of books and you're stacking them up and you think that you're getting somewhere, you're not, because you don't have any skin in the game. It's like somebody that just got an MBA versus a kid that ran a startup for 3 years and it failed. When you talk to those two people, they are very different people, because one was in the trenches and had real world experience, and the other one is very well versed, probably more well versed on a lot of the terminologies and certain things in the business world, but they didn't have any skin in the game. So you want to have a good medium, honestly. I'm not saying go broke and totally risk everything, but set aside a little bit of money, money that you can lose. And I don't know what that number is for you, but consider that money pretty much gone. And construct a portfolio. I would say start with 5 to 7 stocks, which is probably more concentrated than you will be in the future, but that way you can really study them. And write out a thesis for all of them. I'll segue into the next thing if you don't mind, but that basically you want to have a trading journal. So when I started out, I would write a page or two about the company. I would print out the chart and write all over it, and then I would give a forward-looking statement as to why I thought it was a good idea, what could possibly go wrong, and what my exit was if things did go wrong, and what my exit was if things went really well. And then I basically sat there and compared and contrasted them. I was still a little bit shorter time horizon, maybe like 6 months later, and then you just slowly learn. But you got to have skin in the game, because if things really go bad and you sell and the market rallies the next week and you're going, oh my God, I just made the biggest mistake ever, it's going to stick with you. Versus if it's paper trading, you can just hit the refresh button and just be like, all right, new account. So you have to have skin in the game. You have to care. You have to have a little bit of anxiety and pain, and you have to track your progress. And then what I would say, at least for me, I didn't really want to be like a long-term investor when I started. I thought that it was like boring, and it just didn't interest me when I was, starting out. I slowly became a long-term investor because I followed the path of least resistance. I wasn't doing well as a day trader. I wasn't doing very well as a trader. I was maybe break even as a swing trader. And then I started technically trend following. And I thought, okay, I'm doing much better in this. And then I started to mix in the fundamentals. And then I said, okay, well, if I'm going to trend follow, I'm just going to keep trend following. So then I sort of over time developed sort of a technical trend following side to high quality companies. And I paired it with the fundamental and valuation side. And that is the strategy that morphed out of me. I never set out with any specific strategy. I put feelers out into the market, and I let the market tell me what works for me and what doesn't. And I think that that's the best way to go about it. If you go out and try to be a certain type of trader, odds are it's not going to work out. You're going to have to let the market slowly mold you over time and tell you what you are good at.
Yeah, I agree. So there's this term that I like to say, that you should stick to your investment character. So find out what works for you, and you won't know your character when you start. You have to give it some time. You have to have skin in the game. You have to choose a portfolio, give it 6 months to a year, maybe even 2 years, because I've been investing for about 5 years now, and I'm still learning about the type of investor I want to be. So I do have long-term positions, but I do some short-term trades, meaning I'll make that thesis, that you said about a company. I'll say, well, based on what I know, based on the current climate, the next few months may be positive, and based on how the market feels as well about this company, they'll react positively to these earnings. So, I'm seeing a price that I'm happy with now that's considered fair. I may take a position now and wait 3 to 6 months. If I'm right, great. If not, then it's still a small percentage of my portfolio that, if it is that, I will assess and say, well, I'm right, but my timing is off. I just add more and give it time. Or I may just sell, take a loss, and just put it in something else. But I'm not trying to figure out daily or weekly what to buy, because I don't have the time. If I want full time,
right, wrong paradigm, it took me a very long time to figure out. One of my earliest trades, I got long Boeing at about 175, and the next day, and this was when I was more trading, so I had a tighter stop loss. So I got long, and the next day news came out about the 737 MAX LEAP engines having a little bit of production problems, and they basically were delaying.
I remember that.
Yeah. So I got stopped out the next day. I was like, okay, I followed my rules. I took a small loss, and of course the stock rallied to 400 over the next 2 years. So that really, for me, put into perspective, okay, what is right or wrong? Was I wrong on that trade? No, I was right. So then why did I lose money and miss out on the big gains? Well, it was my time frame. Yep. So it was my time frame, and it was my position sizing. So a lot of times it's not about being right or wrong, or how right or how wrong. It's how you go about it. If I put on a smaller position and said, I'm going to give this thing a little bit more time and a little bit more wiggle room, I would have had a fine trade workout. But those are the things that you don't realize about you and the market until you do them. And things can look really good, technically on the book, and you can plan everything out. But these are the things that slowly come with experience. So time is a factor that a lot of people talk about, having a long-term time horizon. But it's also about giving things the time to be right or wrong. I've been down on positions. I mean, I was down on Square for almost a year, and then COVID hit, and then I was really down on Square. And now I'm, it's, I don't think I'm up like almost 150% or something. It's down a bit, but
Yeah.
well, I wasn't wrong on Square. I just needed a year or so to realize I was right. And that's a very weird thing. There's no other profession in the world that says, what are your thoughts about this, A or B? And you go B, and they go, okay, we'll tell you in a year and a half. There's nothing else like that. It's very hard to wrap your head around.
Yeah. And so that's what I saw as well with COVID, where there are a lot of companies that seem to be the best thing, promising year. 2020 was going to be their year. And then March came and they're, scrambling for cash, or they're bleeding through cash so quickly. And then there are a lot of companies that were making the right decisions, investing in the future. COVID came and their businesses just went all the way up. So,
yeah, no, it was an interesting time for sure. It was an interesting time for sure. It's interesting that a lot of the forward-looking companies kind of benefited from it. I mean, it was also a very good time to be a big tech company. And it was a good time to pick up stable names. That's probably the number one thing I didn't do during COVID. I got into Boeing at a very good cost basis, but when there's big market gyrations like that, obviously everything's on sale, but it's a scary time and people don't know the future. So those are the times to pick up stable companies, industrials, Boeing, Home Depot, Berkshire Hathaway B, things like that, their value is pretty stable. And even if things are tumultuous in the future, getting them at such a big discount can pay off. So
yeah. It's one of the hardest things though to buy when everything is down. Like, it takes a lot of discipline to buy when you buy today and tomorrow it's down and next week it's down and a week after it's down, and you're like, well, did I buy at the wrong time? So I mean, that's really hard.
Yeah. And that's why, I mean, I'm not going to get too deep into this, but that's why, I mean, the word value is tossed around, and value is it's a moving target, and people go about it differently, but valuation is really risk management. It's risk management in the fact that it gives you confidence to hold a company if you think you have a fair idea of what it's worth. And it'll also stop you from doing anything stupid. I mean, like, I still think Unity Software, which is the ticker symbol U, is a really interesting company. And I was watching it trade up well over 100, and I was sitting there going, I was like, I can't rationalize this company being more than a $60 or $70 stock. I mean, I like it, but I just can't. The same was sort of true with Pinterest. And because I did my homework, and I was anchored to a ballpark range price that wasn't cheap, but it just made sense. Valuations have to make sense. And these things were just trading in areas that didn't make sense. You have to be able to value these companies to keep yourself from getting caught up in a lot of this momentum.
That's what I kind of noticed before COVID. A lot of companies were actually selling at prices that didn't make sense. And to me, and I think we spoke about this on our first conversation, like, it's like COVID came and you were saying it's like the market did this thing where it was a pullback and then just kind of propelled it forward, because I mean, there was a lot of talk about, potential, recession. The market was at all-time highs. I haven't heard that talk since COVID. It's like everybody's forgotten about what we're saying before. So that's interesting to me.
It started, it's like just starting to creep back in. Yeah, the whole COVID thing is interesting. I mean, I could go into it for a long time, but yes, the fracture that happened within the market not only caused everyone to get out, it caused everyone to get back in, and it also attracted a large percentage of retail traders to hop on that trend. And it basically propelled the market to very frothy levels, not because of anything that changed fundamentally, but just because of the gyration of the market. And it's interesting to see. I mean, the S&P is a lot higher pre-COVID now than it was then. We don't really have that much of a fundamental difference in the business.
Exactly.
Some of them probably are still licking their wounds. So that's...
And it's the same for in Jamaica, where a lot of companies are starting to recover. A lot of them have already passed some of their pre-COVID prices, except for maybe the financial industry. So almost every other stock is getting back to where it was. And I'm like, well, it's interesting to me because COVID is nowhere from being over. but I guess persons are a little bit more comfortable with the environment to, kind of, I guess, be comfortable paying what they used to pay. I'm not sure, but I think persons have an interesting expectation of future, revenue.
The market's always looking 2, 3, 4 years out, which is why it recovered as quick as it did. I mean, the market recovered way before the whole pandemic showed really any signs of easing, and it got ahead of itself. And I think now it's sort of saying, okay, we overdid it a little bit, and it's pulling back. But this is sort of why I don't really pay attention too much to the macro stuff or to opinions, and I kind of just follow price action, because all opinions are baked into the price of the market, and price might not be correct, but it is true. It is the means that you're operating in. Whatever the stock closed at today, that's what the market's valuing at. You might think it's worth more or less, but guess what? That's what it's trading at. So understanding that and just being honest with what's going on, and it might be fine. It's fine if you hold an opinion, but don't let it get too much in the way of you making money, which is the bottom line.
Agreed. All right, so I want to get to some of these comments so that we don't lose them. So Mio is saying that we're good on time. So Mio is saying cash flow from operations still confuses her a little bit. Can you shed some light on that? How can she understand better cash flow from operations? What does that mean?
Yeah, so again, it depends on the company. So there's basically, once you have your operating income after tax, what happens is that they take out you go then to the cash flow statement, and they're going to be adding and subtracting cash to then get your operating cash flow. So certain things like depreciation and amortization is going to be in there. Capital expenditures, actually, I think that's on the balance sheet. But basically, they're going to be adding and subtracting cash from operations, operating capital, to then get you a truer, a more accurate representation of what the company's actually producing as far as cash.
Yeah.
Because when you're on the income statement, it's still kind of in an accounting metric. And then you're going to add in the cash flow from investing and from financing. So think of a lot of these things are actually as literal as they sound. When you hear cash flow, it's literally tracking how money is flowing in and out after operating income, after taxes is being put in. So, don't get too caught up in the terminology, but it's basically just showing what's being added after you have your operating income and what's being subtracted so that the business can continue to operate. If you have a lemonade stand, you need money to operate it. So that's just try to simplify things like that.
Okay, cool. All right, so Deborah is asking, where does gut feeling, what role does gut feeling play in investing? Like, should you follow your gut all the time, sometimes, no time at all? What do you think?
So gut feeling from the experiences that I've had, as far as a specific business, I would trust. So if you come across a company and you just have a feeling, you just know, it just makes sense to you. It's like when you go shopping for clothes and you put it on and it just immediately fits, and you're like, oh, this thing's great, I'm buying it. So in a gut sense, I trust my gut when I first come across a business and I just immediately start liking everything about it. I read about the management and the founding. I like what they did. I like the product. I like the platform. I like the market that they're addressing. So I trust my gut there. So then once it's past that filter, then I do kind of more technical, analytical stuff regarding the income statement, balance sheet, reading the 10K, things like that, doing valuation work. So that's kind of where it ends. You don't really want to just be like, oh, I like this company and jump for it. Let that be kind of a filter. It's like when you first meet somebody, you can kind of get a gut feeling if you initially like them or not, but then it takes time. I would trust your gut on that. And then on the flip side, as far as buying and selling, I would work against your gut feeling. So if you're looking to buy stocks or you're looking to sell stocks, if you're looking at the market and you're feeling warm and fuzzy, you should really consider to trim positions and raise a little bit of cash. And if you're looking at the general market and you're feeling down. You can't believe that, you're down as much as you are. You just don't even want to look at the screen. You're just like, screw this. I don't know why I ever got myself into this predicament. That's when you should be buying. So those are kind of the two gut checks that I use. It's an initial fundamental gut check for businesses, and then it's an opposition to how I'm feeling when I want to deploy capital.
Nice. All right. And I'm sorry, I can't pronounce that name. Is Yaja. Hopefully I said that right. Is asking how low below the last trading price of a stock should you buy? It's an interesting question.
How low before the previous, say that again?
How low before the last traded price? So I guess that's a closing price. Say close at $10 today, for example. How low below that price should you buy? I guess if it keeps going down or something like that, maybe.
Yeah, that depends. I mean, prices can persist for a very long time. I mean, we're seeing that now. People thought it was great to buy these stocks down 20%, and now they're all down 60%. So and even I caught some falling nice. My answer to that would be to have patience and wait for the price to confirm what you're thinking. So if you see a company that you like and it's trading down, not day after day, but week after week, because you're going to have 2 or 3 dead cat bounces up, in there. And those are going to, like the last few days, those are going to look good to hop in, but let price tighten, let the volatility drain out of it, and wait for a higher low to be put in. It's generally what I'm looking for. You don't want to buy stocks in downtrends, period, long-term or short-term. So if you have a stock that's in a long-term uptrend and it goes into a correction and it puts in a short-term downtrend, meaning lower lows and lower highs, wait for it to consolidate, wait for it to go sideways, and then wait for it to put in a higher low, which means that you now have people entering the market willing to buy it at a higher price. That will give you a better entry point, and then you can use the low at the bottom of the base as a possible place to put a stop loss if that's what you want to do. But that'd be my answer.
That is excellent advice, because it's so first of all, I'll say the price going down for one day is not a downward trend. Okay. So I mean, some persons,
it is if you're on Twitter.
Some persons really freak out if a company is like, what I do when a company is down is look at the percentage, because sometimes if it's 100 and now it's trading at 90, they're like, it's down $10. Well, that's just 10%. 10% isn't a correction in my opinion. And if I find that it's 90, then it's hovering around 85 to 90 for a week and a half. Then, as you say, as persons starting to buy at those kind of higher prices like 86, then 87, then 88, then that could signal an opportunity. Okay, it's stable down a little bit. Maybe I can buy. Because there's nothing else that I see that could make it go maybe any lower. So that's and then of course you may be wrong, but at least that's a more stable position to enter, as opposed to if it's 90, then 80, then 70, then 60. Maybe you want to wait. I mean, you can't time the bottom, but you can wait a little bit until it's 40, then 42, then 43, then 40. That's a little bit more stable than 60, 50, 40, 30. You may be, being set up for some trouble there.
Yeah, no, totally. The market doesn't send you awards for picking the bottom. You want to be absent when all the volatility is coming in and it's making new lows. And, you'll get used to hopefully having patience and paying up a little bit more in the name of safety. It's just a better long-term strategy. Yep.
All right, cool. So let me take one last question before we get back. So Akeem is asking you, what do you prefer between ETFs and index funds?
Well, if you just want a dollar cost average into the stock market and not think about it, I would just put it into an index fund. I mean, ETFs are just more concentrated index funds, essentially. So the problem is that ETFs are great, but I've just been seeing a lot of stuff that I don't like with ETFs. They're almost becoming something that can just be thrown at the public based on what the public wants. I'm not going to name names, but
I think I have an idea which one you're
Yeah.
talking about.
So I don't know. I mean, if there's a specific space that you're interested in, and you think you understand, if you want to get into like a fintech ETF, I think that that's okay. I think Vanguard and Spider generally have good ones, and Kathy's are okay. But the thing about Kathy is that she's just been caught up in part of the frenzy, and anytime a trade gets,
I thought you weren't going to talk about it.
yeah, well.
Go ahead. Yeah.
When you have that much hype around certain things, you just don't want to participate in it, whatever it is, ever. So I would just let her ETFs cool off for a little bit. The idea of them is fine. I still think her plan for innovation will probably work out over the short term, but let's not kid ourselves in the fact that she also is aware of what retail investors want and the areas they want to invest in, and she's tailor-made a lot of these ETFs to fit people's ideas of that. But I still think ARK does a good job, but I would just let some of the ETFs cool off, and just, pick and choose carefully. It's the best thing I can say. There's a little bit more risk in an ETF than in just an index fund.
Yeah.
Index funds are also good too, starting off. Sorry, just real quick. If you don't want to construct a portfolio of like 7 or 8 stocks, construct a portfolio of 7 or 8 ETFs and do some analytical work on like the top 2 or 3 holdings. That's also a good way to start. You'll have a little bit less volatility.
Okay, cool. All right, so we're gonna get back for persons with questions. Definitely continue to post them in the comments. At this point, I'm gonna ask if you've been with us this whole time, finding value in this discussion between me and Nick. Please leave this video a like. Also, remember that we have Learn, Grow, Invest t-shirts available. Nick actually said before that he wishes that he could get one, so that's something to note. So the link to order is in the description of this video, so just check the description and you'll see a link to place your order. So let me jump right back to our question. So in terms of we have a few key points left, but there's this concept that we spoke about sticking to the things that work and moving away from the things that don't work. What does that mean for you?
Yeah, so that was when I was talking about how I didn't initially plan to be a long-term investor. It really comes down to letting the market mold you. So instead of saying I'm going to be XYZ type of trader, I just think you should be open to going in the path that works. So if for whatever reason you're good at identifying specific patterns with companies in specific sectors, if you can consistently make money, you're kind of succeeding at this game. That's the whole point. Is consistently making money. The way that you do that can be totally different from everybody else. Usually the ways to do it that are very good are very different from everybody else. So don't come into the market thinking that you have to be a certain type of trader. Keep a trading journal, realize what you did wrong, realize what you did correct, and then just keep doing what you did correct. Add to that side of your playbook. Understand that arena a little bit better, and you'll start to see yourself specializing in an area that consistently works for you. I mean, you just have to, your strategy has to tailor fit you.
Yeah, I agree. So, I say to persons all the time that I'm a very average investor, but I'm patient. So I know that patience is one of the things that work for me, because I don't really get into the technical analysis, but I'll understand the company, I'll research a company, I'll understand, how they've been doing in terms of business, just from my experience with running a business. And then I'll say, well, let me just give this some time. So I give myself enough time, as you said, to understand and kind of get some of the reflex emotions out the way. And then I can say, well, I'm not gonna keep this because it no longer meets what I've set out that I'm going to keep in my portfolio, but I'm going to hold on to this because it could just be a matter of time. So it's important to understand what is working for you. If you've made money before, you did something right. If you've lost money before, it could be that you got some of it right, but not all of it. So just do away with what wasn't right. And it could be a matter of timing, because if you lost money because you sold early, the answer could just be to give it more time. It could be that you need to lengthen your time horizon instead of maybe trying to if you buy and sell based on Twitter, you may be setting yourself up, you know?
Just maybe.
All right. So in terms of, I wanted to ask you this as well, Nick. How do you interpret your losses or mistakes? Like, I know we didn't plan for this one, but how do you interpret if you've lost money, if you've made some mistakes, how do you kind of treat with that?
Yeah, I'll sit down and I'll probably write about it. Writing is a good way to get clarity of thought. Generally speaking, my mistakes don't come from being wrong about a business. They come from timing. And timing, again, is sort of a gray area where a lot of people are just like, don't try to time the market. You can't do it. I have a slight difference in opinion, and I think that you can generally time the market by looking at the level of participation from retail, doing a little bit of technical analysis, and just if you're buying into the hype, to put it mildly. So a great example of that right now would be crypto. I'm not going to get into my views on crypto. I don't love or hate crypto, to put it politely, but if you were buying crypto in 2016, 2017, when it wasn't really heard of or adopted, you were participating in a trade that was quiet, and that wasn't crowded. And if you got into crypto in 2019, when everybody was talking about it, everybody loved it, and everybody was making money, you were buying into euphoria and a crowded trade. Now, Bitcoin is an extreme example of that, but those sort of vicissitudes happen with all stocks, with all assets that trade on the public market. So I have made mistakes where I buy towards the top because I buy into the fundamental story more than I should, and I don't do proper valuation work. And what happens to me is I end up sitting on a loss for a while. Like I said, I have enough confidence that I do want to own these companies in 3 or 5 years. If I have to sit on a loss for a year because I paid up for it too much, then I generally will.
Yeah.
But just going back to the original question, I would just write things out and I would just look for other areas to grab information from. Where was the percentage of stocks relative to the 50-day moving average in the S&P? Were you buying at a time where almost all of them were above the S&P 50-day moving average or below? Was this a time when people were just raving about the stock, or was this a time when no one really had heard about it? Or if it is fundamental, if you did screw up, if the price action went down and you sold out and you had a loss, why did it go down? You want to find cockroach-like businesses that are impervious to certain things taking them down. I mean, as much as I like a lot of the high beta growth stuff, it's good to have some steady compounders in the portfolio, especially early on. And sometimes it can be better just to find a stable cockroach-like business that's hard to kill, that's a leader and has a durable competitive advantage, than it is to buy some revolutionary business that you don't understand.
So one of the things I'll share as well, fully agreed with you there, Nick. When I see a company going down, I look at the volume of stock, the volume in terms of movement that is associated with that price going down. Because sometimes, so based on our market where you can buy now as little as 1 share, the price can go down on 10 units or 15 units. It doesn't mean that the market is now bearish. It just means one person sold that at a price that maybe they were just being impatient. Maybe that's the amount that they had and they just needed to cash out. Like, there's so many reasons to sell at a stock that I usually look to see if it's heavy volume. Then I still say that for a trade to take place, somebody has to sell, somebody has to be willing to buy. So if somebody think the price is going down, there's somebody on the other side saying that the price is just right for them and they think it's going up. So it's always this thing where, I mean, there's always somebody who is bullish when somebody else is bearish, because the bullish persons are buying from the bearish persons. That's kind of how I look at it.
Yeah,
somebody has to
that
buy.
your markets are that illiquid. It sounds like they trade pretty thinly in Jamaica.
Yeah, that's actually one of the things that a lot of persons lament. I mean, there are some stocks that I do not look at because if I can't, I like to trade at a certain volume, and if I can't close that position quick enough, I'm not going to, even if it's a good company, if it doesn't trade a healthy volume, I'm not going to personally look at it. Now, it doesn't mean that persons can't do it. It depends on what their needs are, but there is a certain amount of illiquidity. It's the word I'd use. Yeah. So there's this thing that we spoke about, Nick, where you said the market tends to feed itself. What does that mean?
Yeah. The market tends to feed on itself in the sense that I'm pretty sure Soros kind of had gathered, at least condensed this idea regarding price reflexivity. So basically, I have it written up on my wall. Basically, all it says is that, and you can kind of interchange all of these. Price feeds off of the perception, which feeds off of the fundamentals. And you can switch that around and say fundamentals feed off of price and the price feeds off of the perception. So what I say with that is that if you have, perception of a company or fundamentals of a company, people's perception of that will then in turn build the stock price. Okay, so you sort of have this revolving wheel of optimism or negativity towards a company. And that kind of goes back to what I was saying about being in a crowded position or getting in when the markets are quiet. So understanding that this stuff all feeds on itself, that if there's a really compelling fundamental story, people's perceptions of it get really elated and high, and then they start to bid the price of the stock up. And then as the price rises, people get confirmation that their fundamental theory is correct, and their perception gets even higher, and then it drives the prices even higher, and it just all continues to snowball and feed on itself. That's basically price reflexivity. So I think that's a very important thing to understand, because that kind of comes down to the psychology of the market participants, is that people are always doing this. And then the second that wheel loses momentum, it changes. The price starts to go down, and then what happens? Oh, well, it's not that great. Here are all the bear reports. And then people's perception of the company changes. And then, like we've had recently, where companies, even though they report great quarters, they're down 15, 20%. Why? Because they were just bid up to crazy levels. It's, like, why are these stocks down after? It's because the market just took them to ridiculous areas. And that's one of the things with like a lot of these like altcoins and stuff like that, is that right now we're in a strong current where people are championing each other's ideas and the market's going up. The second that starts to slow down and there's a chink in the armor, or one or two people start to say, hey, look at this, why is this happening? That whole thing reverses and starts to backpedal, and generally markets go down faster than they go up. So it's just something to think about when you're getting into something. Is this being bid up due to people's perception and reinforced by the market and reinforced by the fundamentals? And these cycles can last years.
Yeah.
So it's just something to consider.
Yeah. So we also, talked about this concept of smart money, average money, or dumb money.
Mm-hmm.
Talk to me about that one.
Yeah, so that basically feeds off of what I was just talking about. Generally, smart money will get in before the cycle begins. And what I call average money, or maybe even somebody like me who will wait for the market to turn, or trend followers, or people who momentum trade, they'll then be the next ones in turn to get into that trade. And then as it really starts to feed off of itself, and you have news cycles talking about the price going up, and you have celebrities endorsing it, or you have whatever it is, and things really start to get
influencers.
Yeah. And then he doesn't accept it for cars. No, I'm just kidding. But then the wrong people get attracted to it. I mean, and I don't have anything against them. If altcoins were around when I was 3 or 6 months into trading, I probably would have blew up my account or did something stupid. But it's just the cycle of things. It's the herd, and the herd needs culling here and there. And so just be aware that unfortunately newer people and people who aren't familiar with how things work, they're late to the party and they get burned. And this can even come from experienced investors and traders who have maybe a correct fundamental view of a business, but they continue to buy it into a bull market. And then what happens? We have a correction like this, and oh, now I'm down 20% on the position. You know, and then they go, well, again, maybe I should just sell it and get in at a lower price. And then they sell, and that's the exact bottom, and it goes up. So this just all comes back to getting out of your own way. Just don't act often, but when you do act, you have to act properly, and you can't get caught up in all of this stuff.
So for those who are new, like, what's the best way to kind of interpret some of these? Because a lot of persons will feel like the day that they bought the stock, the very next day it goes down, and they feel like they're poor at picking stocks, you know, because they just always happen to buy at the peak or whatever, you know, time they buy it, it goes down. And I mean, it's really hard when you're tracking your portfolio to see it in red, not really knowing what to do. How do they interpret those actions as you know?
I mean, don't judge it on a daily basis. Give these things time to develop. But the only real way that you'll learn is by buying the top and getting burned and studying it. So that kind of comes, and that's why in the beginning, don't bet a lot of money, keep a trading journal, so that when you do pay tuition and you do lose a little bit of money and it sticks, at least you can reconcile it by understanding why it happened. That would be my advice. I mean, there's nothing really I can say that'll stop you from getting into a stock at the top besides experience and just eventually learning that, you know, there's certain times to buy and there's certain times to do nothing. I mean, really 1% of the time or less you want to be buying. 99.8% of the time you want to be sitting and doing nothing and reading. And the other, you know, 0.1% of the time you want to be trimming or selling. And that's just hard to stomach. People don't want to sit and read all day.
Yeah. All right, cool. So in terms of, I mean, in terms of how one should think about investment psychology, like on a personal level, what are some of the things that they should think about or understand about themselves? Like, what are some things they should be always aware of? Like maybe a checklist of things that they should be aware of.
Definitely not only in yourself, but where the market is collectively. Are you witnessing a lot of greed? Are you witnessing a lot of risk taking? What does that tell you about the current market participants? You know, things like that. And then you can sort of rewind that back to you. Okay, how am I acting? Do I feel like I'm missing out on trades and investments? Am I watching other people get rich around me? You know, and then also in the inverse. I mean, you almost always want to be acting in opposition to the masses as far as the market. So if you see people, I mean, I'm hoping that a lot of my favorite names start getting, you know, people's perceptions turn negative on them, because those are almost always the best buying opportunities. You know, if people have been touting a stock for a very long time and, you know, they start to talk about, you know, how, oh, okay, well, it's not that great. You know, I'm down a lot on this position. Maybe the multiple is too high, whatever it is. You know, it doesn't matter what the reason is. It matters people's emotional state towards the asset. If they're euphoric towards it, it probably isn't a good time to get involved. If they're depressed and upset that they are even aware that it exists, it's probably a good time to buy. So again, it just sort of comes with experience of seeing how markets operate. I mean, it really does come down to behavioral economics. Markets are mobs, and they move like a big herd of wildebeests, and you don't want to be on the wrong side of a big, angry wildebeest.
Yeah. And what I've learned is that people aren't always honest when they tweet about these things. Like, some persons embellish, some persons say things knowing that they could potentially influence others to do something. And I'm not calling any names either, but like I've seen persons intentionally do that. Like, I'll see something just out of the blue, this company X, and I'm like, well, okay. So when I see those, what I'm saying is, okay, this person has probably set up themselves in a position before. Now they're ready to see it move. So they're saying, hey, everybody, look at this thing that this company is doing really well. Why is nobody paying attention to this? because they've probably already added to their position. So
yeah, well, if they have enough followers, I mean, people can slightly move markets. A good rule of thumb with Twitter accounts is that the best Twitter accounts usually don't talk about specific tickers and stocks. They talk about process. They talk about how to invest regarding decision making or the process, or how to look at certain things. They're not just telling you, oh, look at this stock because of X, Y, Z. That's not going to get you anywhere. It might get you followers, but it's not going to get you anywhere as far as learning how to play the game.
Yeah. And actually, so that is, so again, nothing against crypto, but that is the thing that kind of peeves me about it, because everything about crypto seems to be an overreaction. So if somebody says something good, everybody's extremely bullish. If somebody says something bad, everybody's extremely bearish. And everything is exaggerated. For stocks, it can sometimes move a little slower, where somebody says something good but not the right person, it doesn't move. But if the right person says it, then everybody say it's interesting to just observe. And I mean, I can't say that I haven't taken advantage of what I see as the obvious thing when persons do certain things. I like to say that if everybody's talking about a company, I'm probably not interested in it unless I've had it for a long time and I think it may make sense to take some profit, because I know the next week they'll move on to something else, or the week after that they'll move on, and then I maybe add back to my position after everybody has moved on.
Yeah.
So I find that works.
Yeah, and there's nothing wrong with owning a stock that you've had for a while that's currently being hyped up or overvalued. It's just kind of part of it. I mean, I've held some stocks for 4 or 5 years, and there's been plenty of periods where I was looking at it going, okay, this thing's totally overvalued. It's getting hyped up, and I'm just going to kind of mentally prepare for a pullback. Yeah. It's just part of it. If you want to be involved in a business long time, the market is going to push it up and pull it down, and you just kind of have to ignore it.
Yeah, agreed. All right. So what are some of the habits that you see with inexperienced investors?
Overaction, for sure. Overaction is the killer. Think about investments like a bar of soap. The more you touch it, the less of the soap you'll have. You really have to, especially when you're new, there's an aspect to this game where you have to prove to yourself that you can do it. And when you're trying to prove to yourself that you can do it, what that leads to is action, right? It's like if you're out there starting a small company or whatever it is that you're doing, you're constantly telling yourself, okay, I got to make these phone calls. I got to go to this promotional event. I got to get going. And that's fine if you're building a business or if you're in another industry. With investing, it's the opposite. It's again, that's why it's just sort of a strange industry. You really want to slow yourself down and develop an understanding of things as opposed to just acting on things. Action does not equate to high quality work in this game. So that would be the biggest mistake that I see people do. They act too much and they don't have patience to let things play out. It's very hard to get yourself in a mental state of saying, all right, I'm going to spend 2 weeks learning about this business. I'm going to wait 6 months for it to come to the price I want it to. And then I'm going to wait another year to see if it develops correctly. But that's the game that we play.
Yeah. All right. So what are some of the, examples or mistakes that you'd share with us just from your own investing experience?
Yeah, so that Boeing trade was one of them. I did the same thing with Roku. I had Roku at like 40 and sold it at 35. I've made a lot of mistakes, both long-term like that and trading mistakes. When I first started off trading, I still remember a day where I lost a large chunk of my portfolio simply because I didn't stick to my plan. And my plan was to buy here and to sell there if it went well, and to exit here if it didn't. And I was almost so shocked at the price action that I didn't react. And towards the end of the trading day, I was looking at a very big loss. And that sort of taught me the view that I have about price action isn't always right, but it is true. And you have to deal with what you can control and what's actually going on. Yeah. And then in the more so like long-term investment mindset, just letting things develop. If you're going to be a long-term investor, you cannot have the mindset of a trader that has a tight stop loss and will not incur any sort of loss. You have to be willing to move around with the market a little bit, to get some of these 3, 4, 5x positions in the portfolio. So selling is always a problem. Selling too early and being too aggressive buying. Just waiting on both ends, waiting for the downtrend to stop and a base to form, waiting for the stock to continue to execute, even if it has a year or two of stagnation. I mean, there's so many charts out there where the stock did well and then it did nothing for 2 or 3 years and then it 10x'd. Can you sit there and do nothing for 3 years? Yeah. So those would be some of my bigger mistakes. I mean, I had M-Face, which is a solar company, at like $2, $260. And I think it's at like 150 now. It was like 240 a few months ago.
You sold that? What? That was one of those you sold too quickly?
It was just one of those, where I just it's like everything in moderation, including thinking. It was one of those ones where I almost overanalyzed too much. Like I analyzed myself out of a good decision. So I was pretty bullish on the solar sector, and I got into SolarEdge Technologies and M-Face Energy, and M-Face was the one at like 2. And I basically, even though I had done my research and I liked both, I basically rationalized the fact that because M-Face was a small cap and it was riskier, that I shouldn't be in it, which doesn't make any sense. And SolarEdge worked out, but I mean, that one will always sting. I forget. I think it was like a 16,000% return or something crazy.
Wow, that is crazy. That's crazy.
So,
all right. So how do you learn from others? Meaning, so there are a lot of persons giving a lot of advice and non-advice on social media, no matter which one you're on. How do you learn from somebody without being caught up in what they may be trying to say or not say? Hopefully that question made sense.
Yeah, this is a tough one because conflating social media with learning investing is like tying balloons with scissor hands. It doesn't go well. It's besides telling somebody that they have to be a good judge of character and pick the right accounts to follow, but that also comes with experience. It's very easy to fall into a lot of these like guru type people who want to sell you some sort of subscription or pitch you a stock list that only they have access to and only they can pick. So to be honest, in the first year or two, I would just stick to observing social media in a broad sense, but don't take it too seriously. And I would put more of an emphasis on actually investing your money and reading high quality books that are recommended by people who know what they're doing. So I made a book list. I'll tweet it out later. But it's hard to judge character, especially now. I mean, I got lucky in the sense that I met people in real life that were doing this, and then I got into Twitter, and I kind of had a baseline to start from. But I don't know about the market out in Jamaica and stuff like that. But I would also say is don't be shy about reaching out to people in real life. I mean, one of the best contacts that I've made, a guy that I speak to pretty regularly, who's a really good investor. He's not on Twitter. He hardly talks to anybody, but I just emailed him. And I was like, listen, I'm a young guy who's interested in this stuff. Would you be willing to meet for coffee? And he was like, sure. And we developed a good relationship, and he recommended a bunch of good reading material, and we chat about stocks over the phone and through email. And personal relationships like that generally last longer and can provide more specific value and feedback than just following tickers on Twitter. So that would be my advice. The social media is just you can just get too easily influenced by the wrong things and the wrong people at the wrong times. The correct way, I think, to use Twitter is to kind of use it as a sentiment gauge. You can almost use it to see what people are doing incorrectly, more so than correctly. And there definitely are some very high quality accounts out there. You guys are one of them, who put out educational material or who put out analytical stuff regarding specific equities or portfolio construction, or if they're in a specific area of investing. And it might be better to maybe look at their newsletter or their Substack than it is to just read their tweets, because you might be able to derive a little bit more information out of that. Print it out, read it, go over things like that, highlight, take notes. You don't want to consume financial information like you do like Instagram or like you do like a cookie. You don't want to just like run through your feed, grab a little bits of this and that, and then, put your phone in your pocket and go look at, some other stocks or whatever. It's education, and it takes time and it takes deliberate focus of things that, aren't easy.
Yeah. So what I'll add to that, and I completely agree, by the way. So I know that, there was this tweet by Yahoo Finance which stated that over the last year and a half, more persons have gone to social media for financial advice. So I think YouTube was like 77%. Then there's Twitter, there's Instagram. So, and the thing is, once you follow a few pages, comment on a few things, then that app is going to send you even more. So in no time, you could be following everybody. And it seems like all that shows up on your feed is information about stocks and, cryptos. And it could get to the point where you are making decisions outside of that space, completely being influenced by that space, if that makes sense. So
it totally makes sense. Yeah. I mean, these businesses have a prerogative to constantly put stuff in front of your face that they think you're going to click on.
Exactly.
So yeah, I mean, if you're consuming financial information like you were eating popcorn, you're going to get fat, or whatever metaphor you want to use. But it's not great. I mean, and it's part of the craze that we're in right now. The amount of people that are, fixated on this and treating investing and trading sort of just like internet gambling. It's not going to end well. I can tell you that much. But
what I've found, and this is just a personal example I'll share here, my sources of influence tend to adjust my mindset about investing. So I'm in a few groups, I'm following a few persons. If for that week I'm heavily consuming, content from persons who trade, the following week I'm gonna be in this mindset. Okay, I need to make some trades. I need to do this. I need to take money off the top. I need to find a good price.
100%. Yep.
So if I'm now consuming information about persons who are saying, go long, think about the next 5 to 10 years, think about your overall portfolio, then I find that I'm a little bit more relaxed, I'm more patient, I tend to kind of weigh things out a bit. And so what I've done is I really have taken the time to curate my feed down. Like I'm muting persons or I'm unfollowing or just something to help me stay in character, because I could actually be completely fine with that person. But if, as you know how these apps work, if I like your posts, 3 or 4 times, I'm only seeing your posts immediately as I open the app. And if I like you as a person, but your investment advice isn't sound, I'm going to start making some bad decisions.
Yeah.
And it's just, a warning to persons, because, it can easily, affect you in terms of your personal decisions. And sometimes you get frustrated, not because you're doing anything wrong, but because you see persons, posting that they're making all of this money, and you look at your portfolio and you're not making anything, and it just kind of disrupts you.
Yeah, that's totally right. Especially if you start to follow specific types of people, they are constantly going to be little voices in your head saying that you need to do X, Y, and Z. I would just recommend following people who don't have any calls to action. If somebody's saying you need to buy this because of this, or, oh, you're in this community and we're not going to do anything because of this, or if just anybody who has any sort of call to action where you're required, not only is it detrimental to you financially, but even worse, there's probably some sort of area that they're trying to filter you into to get some sort of transactional fee off of you for some sort of service, or they're pushing you into a trade that they bought a year ago. I wouldn't underestimate the immorality of of people
Yeah.
talking stuff online.
Yeah, but because you really don't know someone's motive. And as I said, I've seen it where, you know, persons are kind of convenient with the information they share. It's just how it works out. And sometimes if you scroll back and see a person's history on that same thing, you know, one week they're saying one thing, the next they're saying something else. It's just interesting to me. So
and there's no free lunches. Anytime you see anybody overly confident about something, listen, there's thousands of very high quality investment funds and investment banks. Somebody on Twitter is not the one who was undercovering some fantastic company. I mean, there's millions of eyeballs on. I mean, we're in a highly competitive market with a lot of participants. So that's why I think it comes down to not what you can do, but what you can say no to.
Yeah, agreed. All right, so I think that's it for the areas that we wanted to cover. So let me get back to some of these questions.
What happened to our 30-minute interview here?
All right, so Mia is saying she actually has an investment journal, so that's pretty cool.
There we go. And see, I've gotten lazy. I should still have one, but
yeah. So okay, so persons are asking if we could go through an earnings report. I don't know if you'd be interested in joining us for that, Nick.
Not really. I think there's honestly more value to be had understanding a company on an annual basis, like going through a 10K, than just delving into what the company did the last 3 months. That's just me.
Okay. Well, I mean, so what we could do is we could still look at that, because I'm sure there'd be value there as well.
Sure.
All right. So let me see any other questions. So Akeem is asking if you believe in growth investing, or, well, what do you believe in growth versus dividend investing? Which is the one that you believe in?
Yeah, I don't believe in putting investment assets into categories, really. Investing is putting money up front now in hopes of a larger sum return in the future. So whether you do that by investing in a high growth company that's still bleeding cash and has the possibility of really hitting it out of the park in 3, 4, 5 years, that's okay. If you are into buying more stable companies that are already cash flow positive and have healthy balance sheets and are sitting on a lot of cash and have a long history of performing well, that's also good. If you want to buy dividend stocks, that's also good. It's just important not to get stuck into this concept of growth and value. They are the same thing. There's just different ways to go about it. No founder sets up a growth or value company. These are just all financial terms that we've attributed to them once they've gone public on the market. So I would just try to get out of that. I would just say, look at the company, look at what it's doing, and look and see if it's trading at a fair price for what it's going to do in the future. And obviously that spectrum is very wide. I'm personally younger. I like to invest in tech. I don't think any stock I own gives a dividend. But that's just me. I mean,
I think dividends aren't a compelling enough reason to invest in a company, because one, it's not guaranteed, and two, there's no way to really you can't judge the consistency of it. So there are some stocks that I have that will consistently pay me dividend. If they do, then I just reinvest it in the same stock. But I have made trades that, I know that some dividends are going to be paid, and I'll wait to sell because I know right when the dividend is announced, then the stock may do a small correction. So it'll trend up while the dividends are announced, just because persons are trying to get in. I may take advantage of that opportunity, but if you build your portfolio just off dividends, then depending on the amount you have in the stock, you may not find that worth it, as opposed to just picking a solid company where you could more than make up for it in capital gains instead. So it's an interesting trade-off, but
you just got to pick what works for you. I just don't like seeing people get stuck in the box of defining certain companies or certain investments as growth or value or whatever.
Yeah.
Just because it really is all the same thing. It'll just make your thinking a little bit more clear if you don't have to categorize them.
Yeah, agreed. All right, cool. So I'm not seeing any more questions. Do you have maybe any final comments that you want to share with us?
Not particularly. I am finishing up a write-up on a company that I think is very interesting called Coursera. And that would probably be a good thing to check out if you kind of want to see more so what I do or how I think about businesses. Talk about the markets that they're entering, why that market should be entered by a business in order to disrupt it or change it or offer a better product, and some of the valuation work that I go through, and just look at the general financial health of a company. So if you go to it's all free. If you go to my Twitter profile, my Substack is linked in my bio, and I'm finishing it up right now. It's a pretty long report. It's about 18 pages, and it should be up there in about 3 or 4 days.
Okay, cool. So I've just posted your Twitter handle on screen. Guys, you can definitely check out Nick on Twitter. He does post sensible content. he may be making some jokes. The thing about Nick, you have to kind of read between the lines for the jokes that he'll make. So you have to kind of a couple of tweets to understand the joke. But yeah. you'll
There's good stuff in there. You just have to ignore like 90% of it.
There you go. All right, cool. So thank you so much, Nick. It was definitely a fun conversation.
This was awesome. Yeah. Thanks for having me on. Thanks for putting out high quality content that people can learn from. So I enjoyed it, and I think we'll do a spaces in the future and maybe just condense some of the stuff we talked about. And cheers. Thanks again.
Yep. All right. Thanks. All right, guys. So thank you so much for being here with us. This was definitely an interesting conversation. And as Nick said, we're thinking of, well, as soon as we can, organizing a spaces to kind of discuss further. As you know, with spaces, we have the opportunity to bring in more speakers, maybe hear from other persons on the topic. So be sure to follow us on Twitter and look out for that. Hopefully it should be within the next few days. You know, a reminder for you before we close off to order your t-shirts. We have a set amount that we've ordered. So place your orders now if you're interested. The link is in the description. Next week, we're going to be talking about using margin or using debt to invest. I think it's going to be a very, very interesting conversation. You're going to get 3 different perspectives. You're going to hear from somebody who kind of plays around with debt. You're going to hear from somebody who does not have anything to do with debt. And I think everybody knows who that is already. I won't call his name. And then we'll hear from somebody who is somewhere in the middle, you know, uses solid reasoning as to why or why not you should use debt to invest. So, you know, definitely join us for that one. And if you're catching this on the replay, be sure to leave your questions for Nick in the comments below. I hope to see you guys next week.